Hi guys, John from Gutenberg Research here, and in this video I'm going to show you a quick demonstration of our Netflix earnings model and show you just how easy it is to plug in your own assumptions. So for this demo I'm going to be using the Tier 2 version of our model. If you go to the Netflix earnings model page, you'll see we have both a Tier 1 and Tier 2. And there's a description of the Tier 1 model, which is a little bit more advanced. We forecast the balance sheet and the cash flow statement, and we use both a market multiple based valuation as well as a DCF valuation. But in our Tier 2, we are just forecasting the income statement, segment details, and doing a market multiple based valuation only. So it's a little bit easier if you're new to earnings modeling. This is a good one to get started with. So first, when you open our models, you'll see that we have color coding systems. So anywhere you see a blue cell, those represent our primary estimates. Purple cells represent management's guidance, and orange cells represent consensus estimates. Then the columns also have a color code. So if you see these columns that have the dark gray, those represent historic actuals that tie back to the SEC SEC filings and press releases. And then the light gray columns, those represent the forecast for the future periods. And the other difference between the Tier 1 and the Tier 2 model is in this Tier 2 model, we only go out to the end of 2018, whereas in the Tier 1, we forecast out the next 5 years. So then just to show you how it breaks down, we have the income statement up above. Below that, we have segment details. So for Netflix, there are 3 primary segments: domestic streaming, international streaming, and then the DVD business, which is essentially in runoff at this point. Below that, we have some income statement ratios that helps us predict the rest of the income statement. Some basic share count analysis, and then a non-GAAP adjusted EBITDA reconciliation. And below that, we have the market multiple based valuation. So let's get started. So first thing to notice is that we have a bunch of cells in the fourth quarter shaded purple, which represents management's guidance. So let's take a look at the guidance that management gave on the last shareholder letter. So if you go to the investor relations page and click the shareholder letter for the third quarter, you can see that they give guidance for the fourth quarter. So they give guidance based on US streaming details, international streaming details, and then total operating income, operating margin, and net income and EPS, which includes the DVD business. And of course, they don't break out the DVD business because it's in decline at this point. They're not spending anything on marketing, so there's really never any big surprises, and it's not a huge contributor to earnings at this point. So one thing to note is that you really don't have to change anything in the income statement because all the assumptions are down here. So we've already calibrated this to meet management's guidance. And the way we basically achieve that is breaking out the revenue by segment in terms of total members, which you can see here, and the average subscription revenue generated per member. And then when you multiply one of those metrics by the other, you get total revenue for the segment. So you can see that we predict domestic members based on a very simple growth rate. And we predict domestic streaming revenue. We just type that in ourselves. And you can see how the historic results have kind of gone. So if you know what's going on with Netflix, you'll know that there's some of the old subscribers were grandfathered into a lower subscription rate in the past, and that is expiring over time. So you can see that they've earned, back in June, they were only earning about $26.30 per quarter per subscriber, and that increased in September to 28. And in order to get back to management's full quarter revenue estimate, we had to go bump it up to about $29.40. And then you can see that in the 2017 year, we just kept it flat at $29. You know, they're facing some competition from Amazon Prime Video, so there is a possibility that that could come down in the future. But that's one of the things that you might want to change in your model. So if you want to take a bearish stance on Netflix, you could bring this down and say that maybe it's going to be $28 per member in March, and then $26 in June, and then $25 in September, and maybe then all the way down to $22 per subscriber in December. Like, that would be a good bearish scenario there. And you could also bring these growth rates down too. And you can see as we do this, the implied price target, actually it's come down quite a bit, but that's a pretty drastic change in overall earnings there. So I'm going to undo that for now. And you can see it goes back up to our 115 price target. And then the other thing is, as you do that, you can kind of keep the panes frozen here and watch what happens to earnings. So even just changing the earnings per member by about, decreasing it by about $1 over the full year 2017, that has a pretty significant impact on earnings and valuation. You could also change the valuation too. You don't have to do it based on EPS. You can do it based on non-GAAP adjusted EBITDA, or based on subscribers, or however you want to do it. It's pretty easy to change the market multiple in the valuation section down below. So once we get a handle on the domestic revenue, you can also change the gross margin. So you can see that we have set the fourth quarter gross margin to 44%, which is about 70 basis points lower than what we saw in September, above what we saw in June, above what we saw in March. And then we just kept it flat for 2017 at 44%. And then we also have an estimate of marketing costs per average member. So if you think about this in terms of the total average number of users, what we're saying here is this is the total marketing cost in the United States to get new members and to keep the members that they have. And when we set it at $2.10 per member, we get back to the contribution margin of 36.9%, which is in management's guidance here for US streaming. So that's also a metric that you can change. So we kept it flat at $2 per member throughout 2017. If you are a Netflix bull, you might want to take this down to the $1.80 that we saw in the March quarter, or you might want to go back even further in history and try to add some seasonality to it. It doesn't really appear that there's any significant seasonality, but if you see it a different way, feel free to plug in your own assumptions there. And then the calculation for international streaming business works the exact same way as the domestic streaming. So once you have a handle on how that calculation works, you can just change the assumptions here. So obviously, the marketing expense is much higher in the international markets as Netflix is expanding across the globe because it's more expensive to enter new markets. So in fact, it was about twice the cost of the U.S. Marketing per member. So it was $2.30 in the United States for last quarter, and it was $4.70 for international. So we have that going up to $4.90 next quarter, and then we kept it about, actually we did decrease it over time. So we brought it down to $4.50 per member, and then all the way down to $4 by the end of December 2017. For international streaming gross margin, we have an estimate of 12.5%, which is slightly higher than what we saw in the third quarter, and we are bringing that up. So obviously we're not going to reach the 44% that we saw in the United States, but over time you could get there. And then for international streaming revenue per member, we have it slightly higher than what we saw in the third quarter, and that's ultimately how we got back to the $947 million guidance that management gave last quarter for international revenue, which is right here. And then we have that coming down slightly in March, and ultimately, on average, staying about flat through 2017. But again, this is one area that you might want to change. And if you think that the company is going to face increased competition or just difficult competition against European content providers, then you could bring these growth rates down. You could bring the average revenue per member down. So it's pretty easy to create either a bear case or a bull case for Netflix. And then for the DVD business, that's in decline. So we've kept it pretty stable. So we have 3.5% decrease in total members each quarter throughout the end of 2017. And we just kept the average revenue per member pretty much flat at $30. And we kept the gross margin about flat at 51%. And the company is not spending anything on marketing for DVD business, so we kept that at 0. Then once you have those items, all of that feeds directly into the income statement. So that would be the revenue, gross margin. Most of the operating expenses are in here except for technology and G&A. So you can see down here we have some basic assumptions here. So this is technology and development expense to total revenue and general and administrative expense to total revenue. So you can adjust those items as well. We kept them pretty stable compared to the historic results. And then in this version of the model, we have average interest expense over time. In the tier 1 model, we actually do average interest expense relative to long-term debt. And then we have a basic assumption for other income and expense, which we basically keep in line with historic results, and then apply an effective tax rate similar to what we've seen in the past. So we have 30% for 2017 and rounding out 2016 at 35%. And when we put those assumptions in, we were able to get back to management's guidance for operating income of $125 million for the December quarter, net income of $56 million, and EPS of 13 cents. And we were able to get back to the consensus estimates for revenue and EPS for the next 4 quarters and throughout the end of 2017, and that's why these cells are shaded in orange. So this view right now represents a basic consensus and management guidance view. So it is calibrated and ready for you to put your own assumptions in. So definitely download it, check it out today. And if you do come up with your own assumptions and you want to post it on our website and we will share it with the rest of our community, you can easily do that on the right-hand column of the model page. You can see there's a submission form right here where you can attach your file and put a little summary of why you changed what you changed, and then we'll post it here for the rest of our community to download. Thanks for watching, and good luck with the rest of earnings season.